Welcome to Bloomberg Markets. I'm Scarlett Fu. Fresh jobs data sparks a reshuffle in the bond market. Let's get you a check of where things stand right now. You look at the S&P 500, and stocks have recovered from yesterday's sell-off, which was the worst since August 5th, that meltdown that was global. Of course, when I say recover, they're not doing much of anything at the moment, which means that they're not falling, so they're kind of recovering. But worth noting here that small caps are gaining, and they're among the better performers when you look at the four major indexes. There are, however, some pretty big moves in the bond market, which are building on yesterday's rally, right? Higher price, lower yields, the 2-year coming down 7 basis points to 3.78%, the 10-year yield coming down 4 basis points to 3.78%. And this after the JOLTS report showed a further slowdown in the labor market, reinforcing the idea that the Fed needs to cut rates by some point in September, but by how much and how quickly is really the crux of the debate. And today's moves in treasuries led the 2s-10s yield curve to steepen to the point where it disinverted just briefly. So if you look at what's happened here, the red part indicates when the yield curve was inverted, and today we got to the point where it disinverted just briefly. This marks only the second time since mid-2022 when the spread between those two maturities briefly went positive. Now, for more on the move in treasuries, we're joined by Bloomberg's Liz McCormick. Liz, we look at an inverted yield curve traditionally as a precursor to recession. And that has been the case, this inverted yield curve, since mid-2022. But recession has never come. So is this still a useful signal?
Yeah, and Scarlett, that's a bigger argument. And I was looking back because through the last couple decades, even some, high-ranking Fed officials have kind of questions. Is the yield curve inversion thing broken as a recession indicator? And after they've questioned, some people thought way back the Fed had, too much of a hand in the market. They owned so many bonds and rates were so low. Of course, we're in a different world now. So I don't know that we can say that inversion linked to recession is broken. We may very well get a recession. This was a very long inversion, like you said. So I think that's always up for debate. But many people are saying now that the curve, like you said, although it's flickering, I'm waiting for it to close in a positive zone. Maybe today, we can hope. But that actually, a little bit before the recession actually starts, you see the disinversion happen because like the market is pricing now, and you've talked about, people are expecting the Fed to cut rates or they've started to cut. And that kind of slowly gets to what most people say is really like a normal curve. You should be compensating for putting your money with the government for 10, 20 years, a little bit more than for a year or 3 months, right? So right. I think that's where we're headed.
So the chart that we showed was the difference between the 2-year and the 10-year. What about other maturities? What about other points along the yield curve? Do they show similar movements?
Yeah, we've seen flickering in different sectors. I mean, the original work of Cam Harvey, who was at University of Chicago, is at Duke now, was on the 3-month to 10-year, so the really broad curve. So, we can see it usually goes in parts slowly through, but everyone in the bond market tends to like to look at 2s, 10s. So for now, that's flirting around. But we have had other segments, 5s, 30s, and other flicker at positive. It would be nice when we can definitively say we have a positive sloping curve across the whole spectrum, but we're far from that yet.
Yeah, we're far from that yet. And in fact, as we mentioned, the yield curve briefly disinverted as well on August 5th, the day of that global meltdown, but it didn't stay that way. And right now, it's still negative. What happens, Liz, once the Fed does actually begin cutting rates later this month, as it's expected to? How do we expect that to change the shape of the yield curve overall?
Yeah, well, you have some folks, and they're probably pan out to be right, that are saying once this cutting starts, you could get back. We've had like this upside down yield curve for so long, many people forget, to a positive slope of several hundred basis points, especially if the economy unravels faster than people think, or we have some exogenous force that creates a crisis of sorts. The Fed can cut fast, and they have in the past. So I think, normal times were, several hundred basis points positive, meaning 2-year yields or at least 100 or so basis points below 10 years. So I think, we've talked about this steepener trade that many were in and have gotten burned over the last year. I know some are hanging and saying when this really kicks in, it's a big winner. So let's see. But I think the Fed has pretty much made clear that they're going to start cutting. It's just a question of, for the market, is it 25 or 50? If Friday's jobs data should give some clarity more on what we think it's going to be. But once they start going, and they've made clear they don't want the economy, the labor market to really crack more. So it should be a steady pace, however fast, we'll see. But I think you're going to see continued steepening of the curve. Plus, I won't get into it too much, but we have a lot of fiscal picture that weighs into the long end of the market, right?
Absolutely. Of course, that could all change as well in November. Bloomberg's Liz McCormick joining us. Thank you so much. All right, that's the fixed income side of the equation. Let's now move back to equities and for a glimpse at some midday movers. Abigail Doolittle has those. Abby?
Well, one of the big movers today, of course, Scarlett, is NVIDIA, right now up more than 1%. It had been down more than 3% earlier after really plunging yesterday, roughly a 10% fall on the day, as investors continuing to re-examine that quarter that they reported that was good, but not the massive beat that they've put up in the past. But we've had a little bit of a rebound, up about 0.9% right now. It will be interesting to see where this stock closes. We, of course, have dollar-yen falling, which could pressure risk assets. It's not happening at this moment, but that could certainly come back to bite. Technically, the stock is likely to fall much more. Take a look at U.S. Steel, up 2.3%. And this, of course, after yesterday's drop on the news that VP Kamala Harris, if elected president, or even right now, supporting the idea that it should not be bought by Nippon Steel. It should stay a U.S. steel manufacturer. The company, in turn, saying if that happens, they will have to slash thousands of jobs. It seems investors are okay with either scenario, with the stock up 2.3%. Now, one of the big movers on the day, biggest movers, Dollar Tree, down 20%, the worst day since 2001. They missed numbers in a big way. Adjusted earnings of 67 cents, missing by about 35%. It was supposed to be a number above $1. Sales, a 2% miss. They cut both the profit and the sales view. So take a look at the plunge. This is a 9-day chart, down 9 days in a row. Today, again, the worst day since 2001. But over this entire time period, if we were to have it on that percentage change, it would be a fall of more than 35%. The company saying that they're seeing their higher end consumers cut back, pull back. Now, there's this interesting story within retail, this bifurcation, the mixed consumer. So here we have Dollar General, and of course, this kicked off. This company had a similar story, although they were actually talking about their low-income consumers not really having the appetite. Right now, down about 40% on the year. And then to the upside, it's really interesting. Walmart up about 50%, apparently taking some of the prize, the cake, from these other retailers. And then in blue, we have Nordstrom. Of course, there's some take-private news on that company today. And then Target just hanging in there with a small gain. So these mixed signals around consumers continue to abound, Scarlett. Yeah,
the retail story has been fascinating so far this earnings season, because it really shows a divide between winners and losers, and investors trying to sift through the rubble there. All right, Abigail Doolittle, thank you so much. Abigail, of course, mentioned Nordstrom, so let's talk about them, because the family behind the company is bidding to take it private for $3.8 billion. For more on this, let's bring in Mary Ross-Gilbert. She is Bloomberg Intelligence senior analyst covering retail and department stores. Mary, this is not the first time the Nordstrom family has tried to take it private. From where you sit, what's the difference? What's new in this latest attempt?
Yes, so Scarlett, you're absolutely right. The first time that they tried to take the company private goes back to sort of that 2017, 2018 timeframe, when they were offering more than 2x the price. So that's what's different this time. And this time around, and that time there was a premium involved. This time around, there's no premium. In fact, you'd almost say it's almost like a take under. So that's what makes the transaction different. Now, when you look at the letter that the company submitted, they're saying, well, really, it's a 35% premium to where the shares were trading in March when the first proposal emerged that the family was looking to take the company private. So that's the big takeaway there. And you'd say, well, maybe this could bring in other bidders. It's kind of an interesting story, but I mean, when you've got the family consolidated shares amongst all the family owning about a third of the stock. Yeah. And now we also have another investor in here that got involved a couple of years ago, and that is the Mexican retailer El Puerto de Liverpool, and they are an operator in Mexico of department and specialty stores, and so they own about 10% of the stock. So you basically have 43% locked up. They just need another 23 to 24% to make this transaction happen.
Yeah.
And in terms of the financing, that's all disclosed too. Liverpool's looking to pony up $1.2 billion in cash plus contribute their shares. So it looks like, and then the Nordstrom family is going to pony up about $500 million. So it looks like they're going to need to raise only about $500 million in cash and incremental debt. And the existing debt of about $2.6 billion will be assumed. So this is really, the size of the transaction is really more like 6.6 to 6.7 billion. That's the size of the transaction.
That's really great context there. So you had mentioned that that did not go through, and part of it was because shareholders didn't approve it, and that now that the Nordstrom family is coming back in, perhaps there might be a bit other bidders emerging. Who would be some other natural bidders here for a company at a time when department store chains have lost relevance and are struggling to capture some market share or recapture some market share?
Yeah, Scarlett, it's a really good question because this is a unique situation because you have the family involved, but also it's smaller. So when you look, they have under 15 billion in revenues. Macy's is somewhere around 23 billion. And so, and the other thing is they have two businesses. They have a full line sort of department store, but there's only 93. Macy's has over 500 stores. Of course, they're going to look to shutter about 150 of those.
Yep.
And so, and those stores, they'll probably look to maybe close maybe about about 10% of that store base. So they're going to bring that down, maybe somewhere around that 83, the low 80s. But they have a fast growing off-price segment.
Yeah.
And that's where there's a lot of opportunity. And now that they've reset that business, they've cleaned all the inventories, the systems are in the midst of getting improved, so they'll be able to do ship from store. And they also have an e-com capability. And the only other off-price operator with e-com is TJ Maxx, which is TJX Corporation. So
great point.
Most all of their concepts have an online component to it. So that makes that an interesting part of the story.
Sure.
And we've been watching the full line stores improve with the way that they're moving merchandise around in the stores, bringing in new brands. So they're really differentiated versus some of the old line department store operators, and thus the difference in their performance in the second quarter.
Mary, Ross-Gilbert of Bloomberg Intelligence, really appreciate your joining us with your expertise. Thank you. Coming up on Bloomberg Markets, we're going to talk about how $35 billion is supposed to be how much is going to be spent at legal sportsbooks this NFL season. BetMGM plans to capture a piece of that market, and the CEO, Adam Greenblatt, will be joining us next. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. It's time now for Stock of the Hour, and it's the two companies behind the joint venture BetMGM, London-based Entain and Las Vegas-based MGM Resorts International, both moving in opposite directions on the eve of the new NFL season. Now, the American Gaming Association projects a record $35 billion of bets will be entered into legal sportsbooks this season. BetMGM aims to score a piece of that action. BetMGM CEO Adam Greenblatt joins us now from Jersey City. Adam, great to speak with you. College football has already begun, and of course, the NFL season will kick off tomorrow. What can you tell us about the kinds and the sizes of wagers that have already been placed before both seasons really get underway?
Well, we've seen continued encouraging growth in the participation of NFL wagering. We've seen strong double-digit growth year on year on NFL futures. For this season, we're offering over 1,000 different kinds of wagering opportunities on NFL futures. And for every single pro game, we'll be offering 450 different kinds of events. different kinds of markets. So a lot to choose from, more than ever before, in fact.
Yeah, I mean, those numbers are kind of stunning. More than 400 ways to bet on each football game on the day of. Can you be a little more specific in telling us what new products you're offering and introducing this year and how they're exclusive to BetMGM?
Absolutely, absolutely. So over the last few months, we've been working hard to integrate a sports pricing business called Nordstrom, which was acquired by Entain. And so for the first time this season, we're going to be bringing the power of Nordstrom to our players. And so the things that are unlocked by that integration are parlay enhancements, easy to build same game parlays, same game parlay plus, pre-packaged parlays. We've got some really interesting, I think, consumer only at BetMGM consumer offerings. So, for example, who's going to score the first touchdown for the 1 p.m. slate of games? That's quite something to kick off the afternoon.
Absolutely. So people will have their choice when it comes time to it. You know, I think about your competition and DraftKings, when they reported earnings last month, they said they were experimenting with plans of imposing surcharges for customers in high tax states like New York, like Illinois. Will you be doing the same, or is it more important for BetMGM to gain market share by keeping customers' payouts higher?
Yeah, I think the latter. At the moment, there's no intent to pass on any taxes to players. There are examples in foreign jurisdictions where that initiative, passing on tax to players, has been rolled back. So, what we really bias for is customer centricity, and so our stance on tax is consistent with that.
Got it. Got it. You've talked, Adam, about how 2024 is a year of investment. So I'd like you to give us some color on what that means and what that looks like. Where are you planning to spend the most to acquire customers? Are you looking to convince those who are on DraftKings or FanDuel to come over, or are you looking to grow the pie through BetMGM? Just give us some sense of how you're moving forward with that.
Yeah, for sure. Investment in top-line momentum is critical for 2024. We stated that is our intent, both acquisition and retention. We've got tremendous partnerships with the social media platform X, with Marriott Bonvoy, and with Associated Press. These are all exclusive to BetMGM. And we also have our how to describe it, a magic potion in Nevada, unlocking the power of Nevada for BetMGM. We have an omni-channel strategy as core to our go-to-market proposition. We have recently rolled out our best-in-class, certainly leading sports app in Nevada, and also linked it with our single wallet framework, which means that players from any of BetMGM states can visit Nevada, continue their betting experience with BetMGM, and take that experience home. And we're excited about the ability to grow our actives base, our revenue base, by using Nevada as the place to acquire new players top line. Additionally, this year we've got the first season for North Carolina. We've got district-wide sports betting in DC. So our market has expanded, as well as it being a market share game. We also look forward to Alberta, which has signaled its regulation coming November, or as close to November as they can manage,
right?
Which will introduce another sports betting and iGaming state.
So sports fans, I think about, watching a game or going to a game for that matter, they're bombarded with betting content. It's kind of everywhere they turn, in the physical space and on their screens as well. And there's some serious questions on whether the marketing campaigns have become oversaturated. So my question to you, Adam, is how do you build up awareness of BetMGM without annoying or turning off potential customers?
That's an important question. We're opting for continuity this year for BetMGM. We've got a brand new campaign headlined again by the one and only Jamie Foxx. And we're going to see him in new situations with new messages, but always consistent with BetMGM as a premium omni-channel experience that is born in Vegas, which is synonymous with hospitality and entertainment. And so we seek to separate ourselves based on that positioning.
So in other words, doubling down on your Vegas roots. Appreciate it, Absolutely. Adam. Thank you so much. Adam Greenblatt is CEO of BetMGM. Now, coming up, we're looking at Volvo, which is pumping the brakes on its EV ambitions, saying it'll no longer abandon gas-powered cars by 2030. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. We've got some breaking news, and we're monitoring what's happening in Georgia because there was a shooting at a Georgia high school that caused an unknown number of injuries. We do know a suspect was arrested in a chaotic scene. Officers were swarming the campus, and students were told to go over to the football stadium to seek shelter. Apparently, one suspect was in custody, according to the Barrow County Sheriff's Office, as reported by the Associated Press. President Joe Biden has been briefed on the matter, and we know the high school continues to be on lockdown at the moment. My understanding is that this happened shortly before 10:30 a.m. New York time, when officers from multiple law enforcement agencies, as well as fire and EMS personnel, were dispatched to the high school in reference to a reported active shooting. Again, casualties have been reported at a Georgia high school, but we don't have the details on the number or their condition. None of that is available at the time. This is Appalachia High School in Barrow County, which is about 50 miles northeast of Atlanta. President Biden has been briefed on the situation. We'll continue to follow this developing story for you.